Hi, welcome to Numerix Video Blog, your expert source for derivative trends and topics. I'm your host, Jim Jockle. Last week, Mohammed El Arian wrote an interesting editorial for Bloomberg View outlining 5 key reasons why he expects the Fed to raise rates later this fall. While nothing definitive came out of the Fed's Open Market Committee meeting last week, all eyes have been on the central bank's officials, leaving market participants debating whether the first rate hike will come in September or December. Joining us today to discuss this is resident FX expert and trading strategist for Numerix, Udi Sella. Udi, welcome.
Thank you very much, Jim. Good to be here.
So I think clearly there's consensus that the rate hike is going to come this fall, but would love to get some of the sense of what you're hearing from the European economists.
Yeah, so everyone, of course, is looking at the Fed setting the tone. So from the U.S. perspective, everyone anticipates a rate hike of 25 basis points by September and 1.75 rate by the end of 2016, which means that the interest rate differential between the European and the U.S. is going to basically broaden. And, you know, in Europe, still the quantitative easing is at full speed. And, of course, the crisis with Greece that needs to be resolved. So it's 2 different economic cycles.
So that brings up a really good point. You know, obviously the Greek drama is still continuing to unfold as it relates to potential bailout. What kind of impact could international events have on the Fed, or is the Fed just going to act completely independent regardless of what's going on in the global economy?
So, Jim, this is truly an excellent question, because one of the concerns of the Fed is that there will be a spillover. So basically, if you like, if people would be running to the dollar as a safe haven, that would basically mean that deflation would be imported into the U.S. And this is one of the main concerns of the Feds, given that, you know, although employment has picked up, it is not translated into inflation. Or basically, you know, the purchasing power of the U.S. citizens has not been accelerated yet. And this is one of the biggest reasons for concern. So basically, the Fed has quite clearly indicated this is not going to be a linear, you know, trajectory, and that they will examine each time, you know, the impact of the global economy, you know, as a part of their decision making, whether they should, you know, raise rates forward. So it doesn't really mean that they're going now just to, or basically it does mean that rates would be, the decision to hike rates would be taken while observing, you know, the geopolitical arena. Basically, that's what the head is hinting.
So let's talk strategy. So you, in your opening remarks, you said, you know, this rate hike has been kind of priced in already into the marketplace. So from an FX perspective, well, you know, what are you thinking about? What's your outlook over the next 6 months as it looks at either currency pairs or on anything pegged to the dollar?
Let's start with the G7 economy. So if we look at Switzerland, we see that there is a serious deflation, where actually the GDP is decreasing. So I suspect that eventually the Swiss franc will weaken to the dollar and to the euro, mostly to the dollar. In Japan, we know that basically the Prime Minister has not only won the elections, but also the campaign against the Ministry of Treasury of Finance, and as a result, there will be no tax hikes, and they want to pursue the quantitative easing. So I would think that the yen will weaken further. With regards to the Eurozone, the interesting thing is that any news on resolution of the Greek crisis actually weakens the euro. And given the economic cycles, I think it makes sense to assume that the euro would weaken further. So we're talking now levels of 1.12. I don't see a reason why we'll not go down towards 105. In the UK, the economic cycle is more adjusted with the US cycle. Therefore, I personally think that the sterling would strengthen from this level, which is like $158 to the sterling. As to emerging markets like Mexico, like Indonesia, like India, Brazil, Turkey, the market consensus is pretty much that they would weaken further against the dollar. Although we've seen tremendous rate hikes in Brazil.
And Brazil's, I think, around 13% at this point. Is that accurate?
Yeah, I believe it's 14%, and the fact that the real has weakened so much, they're actually dumping commodity prices like sugar and pushing the prices of commodities down because they need to generate sufficient cash.
So, just one final question before we close. What's the thing that keeps you up at night over the next couple of months? What's the thing what would be the surprise or the thing that's in the back of your mind right now?
Well, with regards to this context, right?
Yeah.
So I think the one scenario that could be scary, and this is what the European politicians or bureaucrats are trying to solve, is that following an exit of Greece from the European Union, if other countries would follow, that could be a disaster. I guess this is the one thing that concerns me most, because if the UK, what they call the Brexit, and maybe, who knows, maybe Northern Europe, etc., that could be extremely dangerous. I think this is the most dangerous scenario, if we're not looking at wars, etc.
Udi, thank you so much and for talking about this. And clearly we want to keep these conversations going with you, something that we're all pretty much keen on to see how this is going to play out, especially as we look at the third and fourth quarter of the year. And of course, we want to talk about the topics that you want to talk about. So follow us along on LinkedIn or on Twitter at NX Analytics, where you can stay up to date with everything that we're talking about on our video blogs. Thank you so much, Udi, and hopefully we'll talk to you again soon.